So the last quarter of 2022 has now come to a close. So in this video, we're going to break down what moved markets over the last year, how we were broadly positioned, and obviously our outlook for 2023. So last year was a tumultuous year for financial markets, to say the least. We saw a lot of extreme events that had a big impact on the global economy. Now, one of the most significant, got the conflict between Russia and Ukraine that's still ongoing, which really caused energy prices to skyrocket and contributed to the already high inflation that we had. In response, the Federal Reserve had to take action. We started to raise interest rates more than they had really in decades. But that wasn't the only thing that shocked markets last year. There was also the gilt crisis in the United Kingdom, which was caused by market forces essentially punishing the government for all their excessive spending in the way of higher yields and falling currencies. And even just days before the end of the year, the Bank of Japan caught everybody off guard by changing its yield control policy. So all of these events, they really, in my mind, serve as a reminder that we have to be ready for really a wider range of potential outcomes because today's economic climate is much more volatile than usual, which I think we can all agree with. So before we move on to 2023, though, last year, global stocks and bonds really experienced a rare joint sell-off, with global stocks down 18%, bonds down 16%. Now, this is only the third time that an event like this has happened since 1990, with the other two instances being back in 2015 and in 2018. Now, those are the global returns. Here in the US, the NASDAQ was down almost twice that amount, and the S&P 500 was down about 20%. So how were we positioned over the last year in response to all of these different events? Now, let me say first that every one of our clients is invested differently. They all leave with a customized game plan. So if you're a client, your experience may be different from what I'm about to talk about here. This is just a general reflection of some of the moves and positioning that we've made and had over the last year and the last quarter. So since the middle of last year, we started taking steps to reduce risks, which essentially have been generally successful on a relative basis. And we did this by getting a lot closer to the benchmark in a few different ways. So we've also been successful at avoiding being fooled by any of the bear market rallies and more optimistic narratives last year. That said, some people who believed in the recent Fed pivot hype at the end of the year, they were only disappointed when they were caught off guard and caught out by yet another short-term market bounce. Because what ends up happening is when the market rallies, it almost gives the Fed more fuel to be even more aggressive and have even more hawkish rhetoric in their stance on rates. So overall, to stay balanced, we kept a mix of stocks and bonds, but we basically tweaked our tactical exposures. So we did this last quarter specifically by starting to buy back into tech stocks after essentially having them underweighted for most of the year. And then we used those gains from the overweights in energy, commodities, infrastructure, and the other parts of the portfolio to buy in. We've also started to favor stocks in other developed countries, as well as the more low volatility stocks, specifically only in emerging markets. The outperformance of international developed markets compared to domestic over just the last 6 months, as you can see on the chart here, it's a great example of why we want to be diversified and strategically take those proceeds from the outperformance over the last 6 months and rebalance into other areas of the market. And finally, we positioned ourselves to have a slightly lower amount of long-term bonds and instead focused on more shorter-term investments like credit and mortgage-backed securities. So 2023, where do we go from here? So if we consider all of the historic shocks of 2022, we've got war, high inflation, and a perfect market storm with interest rates between stocks and bonds, this has definitely taught us a few lessons for the new year. First, we need to consider really a wider range of possible scenarios and be aware of things like inertia and behavioral biases like recency bias. Second, we should factor in compensation for geopolitical risk. And last, third, we need to tweak our investment game plan, our investment playbook. So this year, there's likely going to be a lot of changes in the economy, including more volatility and possible recessions in some major countries. Now, to deal with these changes, it's important for investors, in my mind, when we look at this new playbook, to consider three themes. We're going to price in the damage, rethinking bonds, and living with inflation. So our first theme is pricing in the damage, which means we need to take stock of how much economic damage has happened already and how much is being reflected in the current pricing. Really in terms of the compression of that price to earnings multiple that stocks trade at. Our second theme is rethinking bonds. Our new playbook requires us to look at bonds differently, including the role of duration in a portfolio, specifically at times of a recession. So for those of you who don't know, duration basically measures how sensitive a bond's price is to changes in interest rates. Essentially this means we have to be a lot more granular in not only the types of bonds, but the tenor, the maturity of the bonds that we own. And our third theme is living with inflation, which means we all know that we need to be aware that there are factors that are going to keep inflation higher than even before the pandemic, even if it decreases in the coming year. And really those factors would be, an aging workforce. We've got geopolitical fragmentation around the world, and this transition to net zero with climate changes. So the bottom line is this: it's important for us to be ready to make more frequent changes to portfolios this year, as in my mind, the old recession playbook might not work as well in this upcoming recession. So with that said, if you're a BWM client, you want to talk more about how you're specifically positioned, please don't hesitate to reach out. As always, stay the course and stay on point. Take care.